All right, so today, in just a few minutes, we're going to start working on the valuation file that we're going to use, and we're going to use cat as our working example, which is Caterpillar. So in Elms, in the Files section, there's a folder called the cat model. And specifically, you're going to need this file, which is called valuation model cat start.xlsx. So you'll need to download that file. I'm going to have the exact same file on my laptop. And for homework 6, which will be due Wednesday at 10 a.m., I am going to create a forecast for the income statement and balance sheet of CAT going through 2020 in this file. Using this file, you need to follow along individually, and if you're able to finish at the end of this video, at the end of this class, then you're done with homework 6. And then you can upload it, and then you're done. If you're not, then you have between now and 10 a.m. on Wednesday to finish doing and replicating what we're doing in class. Right? On Wednesday, we'll then pick up with this file, and then from there, we'll finish the valuation part of the CAT file by end of class Wednesday. Again, you'll either do it in class and or do it by Monday at 10 a.m. Okay, so then by next Monday, we would have finished pretty much most of the valuation model for CAT. Now, the nice thing is that this model becomes a reusable model. So it's going to take us about 2.5 hours to actually do the entire valuation file. You'll then be able to use this on your group project, and it should take you 10 minutes to then use it with a different company. Okay, so we're building a reusable model. Now, this is something you're going to use for your groups. However, for the next 2 weeks, while we're working on the CAT valuation, you will be doing this individually. Okay, so you're not allowed to share files. Sharing of files is an honor code violation. So everyone must individually create the model themselves and upload the file, a unique file, themselves as you go through this process. Okay? So I'll give you a second to download that file. This is homework 6. So basically what we're about to do, you need to follow along with me and replicate everything I do. If you're able to do that by the end of class today, you've completed homework 6. If you can't complete it by the end of class or the end of this video, then you have until Wednesday at 10 a.m. to complete it and upload it. Okay? And again, I'm recording this on video, so this will be on YouTube later tonight. Okay? With screen capture. So I'll have the screen capture as well as the audios. All right, but again, this is our reusable valuation model. So let me talk a little bit about the structure of this model. It has a series of tabs which go from left to right. Right? The first tab is called Model Data. So what I did is in Bloomberg, I went to the FA section of Bloomberg, and I went to the Custom tabs, and I created a custom form called Model. Okay? And basically, it has these income statement, balance sheet, and cash flow items, right, in this order. There's about 70-something of them, and these are the field names within Bloomberg. So what you're going to have to do is a homework assignment coming up. Now, it's not for this Wednesday, but in the next week, you're going to have a homework assignment that basically says create a custom FA tab that has these items in this order. Okay? And the order is very important. Okay? So what I did is I then took this save template and I exported it using CAT's data. And I have 6 years of historical data. As a matter of fact, the exported template, if you go back to Canvas, is in the Files section under CAT model, and I called it cat.xlsx. Right? That's the data for CAT. Right? Now, here's the thing. That's what this entire valuation model is based upon. Okay? So based on this model data, I then created a tab called the Income tab, where I recreated the historical income statements in a common standardized format. Right? And then I created a Balance tab, which recreated the historical balance sheets off that model data in a common standardized format. Right? That's going to be important because let's say I wanted to do Deere or Komatsu, then I would go to Deere, I would use the same Bloomberg model tab. I'd export it in the FA. I would then copy and paste and overwrite cell by cell what's in here, and then it would flow through, and then it would create it for any other company. So this is what I mean by creating the reusable model. Okay, so by mapping it to Bloomberg, and that's the point, I've now mapped it to Bloomberg for you. So I got all the fields that we need from Bloomberg in the model tab, the model data tab. I've then recreated the income statements and balance sheets based on that model data. Then I created a tab called TFI where, just like you did on the midterm, I then map to the balance sheet and reorganize the TFI historically using relative references, just like you did on the midterm exam. And then I did the same thing with the income statement. I created a TII, which I mapped to the income statement and rearranged it, which led me, and this is what we really need, to the CFI. So there is the mapped, created CFI off the TII and the TFI. And then I created the economic profit, BOI, and EOI tabs. Okay? So basically, what you did in the midterm, I did for you as the starting point of the model, except you did it with a hypothetical company, I did it with Caterpillar's actual data. Okay? So I then have a tab called ROIC chart, which graphs the historical ROICs, and I have one called ROIC drivers, which creates the tree that we just went over for Apple as an example. And there's the tree that's automatically created. And again, all of these are relative references. So if I put new data in the model, everything will flow through and update all the tabs appropriately. Okay? And that's exactly how we create a reusable model. So the idea is, that's what I mean by it'll take 2.5 hours to finish this one and then 10 minutes to do model number 2, because model number 2 is go to Bloomberg, put in the company, go to FA, export the custom data, and then overwrite this model tab, which will then update the rest of the spreadsheet automatically and dynamically. Okay, that's what we're eventually getting to. But final 2 tabs I want to talk about, ratios and assumptions. So our goal, and that's why we start with the historical data, but we want to create a valuation which is based on the forecast. So we have to create a forecast for the CFI, which means we have to forecast the income statements and balance sheets. So today is about forecasting 6 years of income statement and balance sheet data for CAT. Okay, so that's what we're going to finish by the end of class today, is the forecast for CAT's data. So the book talked about, in the reading for this week, the best practice for forecasting is not to directly forecast the income statement, but to forecast ratios. So the ratios tab is critical because these are historical income statement and balance sheet ratios. And what we're going to do is we're going to create a forecast of the ratios, and the forecasted ratios will create the forecasted statements. That's the best practice. That's what we're about to do. Right? I also created a tab called Assumptions, which has some miscellaneous assumptions that will be part of our forecast. And I've introduced the color yellow onto this tab. And it's very important to understand why I did and chose these yellow colored tabs or cells. And the reason why is we're building an extremely complex model and we're going to reuse it. So when we reuse it, there's going to be certain areas that we want to change and certain areas we don't want to change. So again, as a best practice, I want to minimize the areas where I change my assumptions. So I don't want to put assumptions on every single tab because my model just becomes too hard to remember everything to change. So I want to mitigate the amount of areas that I change things. So in our model, we're only going to have 2 tabs where we change things, the ratios tab and the assumptions tab. And then I'm highlighting using the color yellow. You can use whatever color you want, but I've chose yellow. And the point is, that tells me that that's something that I could change. So if it's not a color-coded cell, then I don't want to change it because it's probably a relative reference or a calculated result. And I don't want to break my model accidentally changing things that I shouldn't. So we're using the color yellow to highlight these are things that are assumptions that I can change versus other things, if it's not yellow, I don't want to change my model. Okay? So that was the other thing that I've kind of introduced here. And we're going to add to these assumptions, but these are 3 starting assumptions for CAT. So back to this. Let's start with the ratios, and let's start the income statement forecast. Now to make it a little bit easier to see on one page, I'm going to hide some of these historical years. If you don't have to hide them, I'm just doing it to put it all on one page. So very important, don't delete these columns. It'll screw up the model. So if you do what I do, hide them, which is right-click hide, all right? Or you can leave them on there, all right? But the point is, I want to start forecasting CAT's ratios. So all of these ratios, with the exception of revenue growth rate, are a percentage of sales, and revenue growth rate is a percentage change. And again, I want to make these relative references so I can reuse the model. I don't want to hard code years, because if I use the model again and the years change, and if I hard code the years, it's going to cause me problems. So therefore, starting with cell H1 equals previous year plus 1, that's going to be my first forecast year of 2015. And the first number I'm going to forecast is revenue growth rate. So equals previous year. So H2 equals G2. And that is the revenue growth rate for 2015 for CAT, which I might choose to change, so I'm going to make that a yellow cell. Okay, highlighting to myself, that is something that I could choose to change. Okay, now here's the way it would work. If I go to the income tab, which is the forecasted income statements, and again I'll hide some of the older years just so it's easier to see what's going on. Again, don't delete. This is going to be part of my forecast, so I'll label this so if I print it out, I'll know what's forecast versus historical actual. Equals previous year plus 1. Again, relative references. So first year is going to be 2015. So here's my 2015 revenue forecast. My 2015 revenue forecast equals my 2014 revenue, so equals G3, times left paren 1 plus from the ratios, my revenue growth rate, H2. Right paren. So, and I'll format this, dollars, 1 decimal place. So the idea is for H3, what I'm saying is if I take last year's revenue and I multiply by 1 plus the growth rate, which right now the growth rate's negative 0.8%, then I would come up with this revenue amount of 54,716. Right? So that's just if CAT's in steady state. For purposes of building the model, we're not going to change the existing ratios. We're just going to leave them alone while we build the model. However, what we will do on Monday, okay, this is a preview. Don't make this change in your model right now, but let's say, just to illustrate this, I think CAT's going to grow at 5%. I change the revenue growth rate to 5%. On the income tab, the dollars adjust to the correct amount given a 5% growth rate. Right? So this is what I mean by eventually, once we build these ratios, we can change the ratios and it will drive the dollar forecast. Now for right now, because I want us all to have the same model, I don't want you to have it growing at 5%. I want you to leave it equaling the previous year as a placeholder, and we will change those later once the model gets built. Okay? So the second placeholder is EBITDA equals previous year, and again I'm going to make that yellow. Now here's the thing, is that EBITDA is one of the critical metrics to forecast on the income statement. And you'll see that they're kind of highlighted here in gray. It's hard to see on the main screen, easier on this computer. But these are the 3 most important items to forecast on the income statement. Revenue growth rate, EBITDA as a percentage of sales, and the tax rate. So here's the thing. This analyst for Morgan Stanley that was here a little bit earlier today, when she forecasts CAT, she forecasts cost of goods sold, she forecasts SG&A, right? But what she's trying to get to is to an EBITDA, right? So instead of granularly forecasting cost of goods sold and SG&A, which is harder for you guys, and to be honest with you, they won't change the valuation model at all, I'm just going to let you directly forecast EBITDA. Just make it a little bit easier. Okay, so that's why we're skipping directly to EBITDA for the forecast. Okay, so that's why I'm also making it yellow, because that's something that we will change. Now, the next line item that we're going to forecast is DA, depreciation and amortization as a percentage of revenue. Again, equals the previous year. The next line item down is operating income. Well, operating income is a function of the 2 items above. It's EBITDA minus the DA. So I'm not going to directly forecast operating income. I'm going to solve for it. So equals EBITDA minus the depreciation and amortization. That would be my operating income of 9.7%. And again, I'm not going to make that yellow because it's a function of the two items above. All right? Doesn't make sense to forecast operating income if I forecasted the components that lead to the operating income. And that's the choice that I'm making. Now, we could have made a different choice. We could have said, we'll forecast operating income, we'll forecast EBITDA, and we'll solve for the DA. All right? But I'm doing it the different way. I'm saying we're going to forecast EBITDA, forecast the depreciation, and then we're going to solve for the operating income. Bear with me? Okay. Next, tax rate. We have to come up with, and I'll unhide this for the time being to see this, we need to come up with a reasonable tax rate for the company going forward. Okay? So one way to do this is I'll take an average of the historical tax rates. Right? The problem is when I take an average of the last 6 years, it looks like 2009 was an outlier for tax rate. They got some weird tax refund in 2009. So an average of the last 6 years is probably not reasonable. So what I'm going to do is I'm going to take an average of the last 5 years, C9 to G9. And to me, that actually looks like a reasonable tax rate for CAT going forward. Now eventually, the goal is we have to come up with what we think the tax rate the company is going to pay on a continuing basis going forward. But the point is, I'll start out with the average of the last 5 years. And again, I'll make this yellow because that's something that I could change in the future. Now, the next line item is no plat. No plat is my operating income, operating profit after tax. So the formula, and you can see that is here in G10, which is my operating income times 1 minus the tax rate. I can actually copy this formula and paste it over one cell so I don't have to type it again. But it's basically my operating income times 1 minus that tax rate that I just forecasted. And again, I don't need to directly forecast my no plat as a percentage of sales because I already have a forecast for operating income and I just forecasted the tax rate. So I'm solving for the no plat as a percentage of sales. That's why it's not a yellow cell. Finally, my non-operating gains and losses as a percentage of revenue equals the previous year, and I will make that yellow. All right. So this is going to be a forecast for the next 6 years. Now I'm arbitrarily doing 6 years. Up until last semester, we actually did 11 years when we built the model in previous semesters. And I've decided to make it 6 years because, to be honest with you, 11 years complicated the models and the students really didn't get any much more value to their modeling by adding in 5 more years. So I'm making your lives a little bit easier by just doing a 6-year model. But recognize that's arbitrary and it's just helping you have a little bit more simplified model. So the point is, we're going to forecast out through 2020. So I'm going to take what I just did, I'm going to copy it through column M, and I have a forecast for these ratios now going through 2020, all equaling the previous year. Okay? And here's the other kind of weird thing, the tax rate. Since I used an average of the last 5 years, when I copied that out, I now have a rolling average of 5-year tax rates, which I don't really want to have. I kind of want to have one tax rate for the future. So here's what I'm going to do in cell I9 equals cell H9. And I'm going to copy and paste that out to 2020. So the idea is I figure out in 2015 what I think my tax rate should be, and I use that tax rate for the future of the business. Okay, as a starting point. Okay, so really what I've done for the first 6 years is I've created ratios that say if the ratios for 2014 just continue 6 more times, these would be the ratios for CAT for the next 6 years. Now, from these ratios, I then want to create the actual income statements. So just like we started with revenue, I'll go to the income tab. So the next item down was the EBITDA. Now, EBITDA was a percentage of revenue. Everything after revenue growth rate is percentage of revenue. So here's the point. For EBITDA in 2015 equals, from the ratios tab, EBITDA as a percentage of revenue, so H6, times, from the income tab, H3, which is the dollar forecast of 2015 revenue. And that would get me an EBITDA of 8419. All right? The next one's depreciation. Equals. Sure. So again, what I did is I took from the ratios H6, which was EBITDA as a percentage of revenue, and from this tab, H3, which was the dollars of revenue in 2015 that we had forecasted. And that gave me the dollars of EBITDA on the income statement. We do the exact same thing for depreciation. So for depreciation, 2015 equals from the ratios tab, 2015 depreciation and amortization as a percentage of sales, times from the income tab, 2015 forecasted sales in dollars. 3136.2. Operating income, I'm solving for that, equals EBITDA minus the DA is my operating income, 5282.8. Okay? So very quickly, we've come up with a forecast for the operating profit, or EBIT, of CAT in 2015. Now, I have to continue the income statement. Here's one of the other things you should have learned about the enterprise DCF valuation methodology. It assumes a target capital structure. So right now, we're going to assume that the current capital structure equals the target capital structure. So we're not going to change the debt and equity of the company we're valuing. Right? So that means for the interest expense, we're going to leave that alone, equals the previous year. We're not going to change the debt, so whatever interest they pay, they're going to keep paying. Now, the real point, and you'll see this on Wednesday, is that the actual interest expense forecast for 2015 has zero impact on the valuation of the company. But nonetheless, we just want to kind of create income statements, so we need some placeholders, and this is one of the placeholders that we're creating. Same thing for interest income, equals the previous year. Foreign exchange gains and losses, as a starting point, equal the previous year. We might eventually put those at zero because they're going to be really hard to forecast. Okay? Next, income loss from affiliates equals the previous year. Non-operating gains and losses equals ratios, 2015 non-operating gains and losses as a percentage of sales, times income 2015 revenue. And I can see over here on the left-hand side, these are the 5 items I have to add and subtract to get to pre-tax income. The nice thing is for pre-tax income in 2014, I had already added it and subtracted it with the correct order of operations. So I can take G16, copy that, and move that over to H16. And that'll basically get me my pre-tax income. Just adding and subtracting those 6 things. Income tax expense. If that's my pre-tax income, my income tax expense would be my pre-tax income in 2015 times, from my ratios, my 2015 tax rate. That's how much I would pay in taxes, $1359.2. For which one? So for the pre-tax income or for the income tax expense?
The pre-tax income.
So the pre-tax income is just from operating income minus interest plus interest income minus FX minus income or loss from affiliates minus non-operating losses and gains. So I had already solved for that, just adding and subtracting, just calling the signs in G16. So rather than recreating it again, which I could, I'm just saying copy G16 to H16. Make your life a little bit easier. And for income tax expense, if that's my pre-tax income, so I would take equals the pre-tax income, so H16, and I'd multiply it by ratios H9, and ratios H9 is the 2015 tax rate. So what's my forecasted tax rate? What's my pre-tax income? That would be the income tax expense. All right, and again, just following the pluses and minuses on the left-hand side, I then subtract my income tax from my pre-tax, and that gets me my income before extraordinary items. So equals that minus that. And if you're looking for help, as I said, you can see what I did in 2014. I'm basically doing the same formulas in 2015. So we're not forecasting things, I'm adding and subtracting things together. Yes?
What's your income tax expense number?
1359.2. Getting me income before extraordinary items of 3676.7. Right? So next, extraordinary loss net of tax, 0. Here's why. The definition of extraordinary means it shouldn't happen again. So therefore, if it happened in the past, it shouldn't happen again, and we're not going to forecast extraordinary events. Because by definition, they're extraordinary. They shouldn't happen again. Right? Not saying that we couldn't always go in there and change something, but what you'll also realize has 0 impact on the valuation, so why bother? Just leave them at 0. Okay? That gets us net income before minority interest equals the income before extraordinary items minus the extraordinary items. Minority interest equals the previous year. Again, if we're going to leave the capital structure alone, whatever minority dividends they're paying, we're going to let them continue to pay at the same rate. We're not going to change that. So minority interest just stays equal to the previous year. Which then gets me to a net income or net profit equals the net income before minority interest minus the minority interests would get me net income 3660.7. Because we're not going to monkey around with the cap structure, if they're paying preferred dividends, they're going to keep paying preferred dividends. Because we're not going to change the preferred stock out there. So equals the previous year for cash preferred dividends. Other adjustments, 0. These are accounting adjustments. Again, we're not going to forecast accounting adjustments because we don't know what kind of accounting adjustments they are, and these are typically non-cash items. So other adjustments, we're just going to leave at 0 for now because we don't know what they are. We're not going to forecast them. That gets me net income available to shareholders. Now, net income available to shareholders is net income minus cash dividends minus other adjustments. However, take cell G25 and copy and paste it to H25. The reason is that I'm going to take H22 and add the cash preferred dividends rather than subtract them because I know that Bloomberg is going to give me cash preferred dividends as a negative number. Okay? So the format that Bloomberg is going to give me the dividends is a negative number. So I don't want to do a double negative and subtract a negative, which would then add it. All right? So just I know that the way it's coming from Bloomberg, so that's why we're going to add the negative number as opposed to subtract it, even though it says subtract on the left, because the dividends come out as a negative number. So that's what I already did in cell G25. Dividends paid, these are common dividends, equals the previous year. Again, we're not changing the cap structure. We're going to leave the dividend policy alone, which leads to change in retained earnings. Again, same point, equals net income available to common shareholders plus the dividends. So even though it's subtracting a dividends because it's a negative number, I don't want to subtract because it'll be a double negative. So I'm adding the negative number in because, again, that's a formatting issue from Bloomberg. So you should end up with change in retained earnings of 2040.7. Now, what we've just done is we forecasted the income statement and change in retained earnings for CAT for 2015. Our final step in the income statement is to take what we've just done, copy it, and paste it out to 2025 in column M. Or sorry, 2020. So I now have a forecast for the next 6 years for CAT's income statements. So we have 6 years worth of ratios, which create 6 years worth of actual income statements, which create, if I go to my TII tab, because everything's a relative reference, kind of like what you did in the midterm, I could take 2014 TII, copy it, and paste it to column M, and I now have, just got to change the relative references on the years, previous year plus 1, I now have balancing TIIs going out through 2020. And that took us about 20 minutes. So within 20 minutes, we basically created 6 years worth of income statements, which gave us 6 years worth of TIIs.
I copied and pasted it, just kept getting dashes off the so.
You got dashes across the top. Yeah, because then you have to change the years to equal previous year plus 1. Because it might have looked like this. I got zeros. And then I had to add the years in for the relative references. Now, very important. What you don't want to do is click and drag. Clicking and dragging is bad. So my recommendation, don't click and drag. And here's why. Microsoft, trying to be helpful when you click and drag, will sometimes try and create series for you. Because they'll say, oh, it must be a series. And then it'll start changing the numbers in the future because it'll create a series when you didn't want a series. So as you're building this model, copy, paste. Control C, Control V. Command C, Command V, depending on on a Mac or PC. But basically, I'd strongly recommend copying and pasting, not clicking and dragging. Not saying clicking and dragging doesn't work most of the time, but it gets really annoying when Microsoft changes it on you and doesn't alert you that it created a series, and then suddenly your model doesn't balance. Happens to people earlier in the previous section. So I'm just giving you a hint on that one. All right, now that we've done the income statement, we need to do the balance sheet. So again, I'll go back to the ratios. We'll start with the balance sheet ratios. These are the 9 balance sheet ratios that we are going to forecast. Now, here's where we're going to differ from the reading in the book this week. So the book talks about how important it is to align the income statement and balance sheet items together. So when you forecast DSO, you tie it to sales. When you forecast accounts payable, you tie it to inventory. When you forecast accounts payable, when you forecast inventory, you tie it to cost of goods sold. When you forecast accounts payable, you tie it to cost of goods sold. That's what the book talks about in the reading for this week. That's ideal, right? What we're going to do is slightly different. We're going to do easy. Easy is every one of these balance sheet items is a percentage of revenue, right? Has 2 advantages. One, it's easier, right? So as revenue grows, the balance sheet grows, which leads to advantage number 2. It gives us the notion of constant productivity. So that's the idea. When the income statement grows, the balance sheet grows with it, and therefore the model will create investment to maintain the current level of productivity. So we can forecast the income statement, which will help us with the forecast of the balance sheet. Now, if we think the productivity differs, then we can change the percentage of revenue. But for now, it'll be easier for us to tie everything to revenue. Okay? And you're really not going to see that much of a difference in your actual modeling if you were to individually forecast the balance sheet. What's most important is that you do forecast the balance sheet. Okay? So, for starters, everything equals the previous year. Everything is yellow. And that is our forecast for the next 6 years. So I have 6 years of balance sheet ratios, these 9 ratios, so 54 different ratios over the next 6 years, all equaling the previous year as a starting point, placeholders. From that, we go to the balance tab, and we start creating our balance sheet. Again, so it'll be easier to see, I'm going to hide some of these historical years. Don't delete if you're following along. I'm going to label this part of my forecast. Help me differentiate. Equals previous year plus 1. And the first ratio is accounts and notes receivable for 2015. So in the balance sheet, I go to accounts and notes receivable equals, from the ratios, 2015 accounts and notes receivable as a percentage of revenue, so that's H13, times, from the income tab, 2015 forecasted revenue in dollars, H3, tells me it should be 16,495. So again, I'll format dollars 1 decimal place. So 16,494.9.
you show that again?
So what I did equals ratios H13, which is the accounts and notes receivable as a percentage of revenue for 2015, times 2015 forecasted revenue in dollars. Gets me the dollars of accounts receivable on the balance sheet. Next, inventories equals ratios 2015 inventory as a percentage of revenue times income 2015 revenue gets me inventories in dollars. 12101.5. Okay, again, ratios H14 times income H3. Next line item is other current assets. Equals from the ratios tab, 2015 other current assets times income 2015 revenue. Long-term investments equals ratios 2015 long-term investments times income 2015 long-term and 2015 revenue H3. Net fixed assets equals ratios 2015 net fixed assets as a percentage of revenue times income 2015 revenue. Long-term assets equals ratios other long-term assets times income 2015 revenue. Next one is accounts payable equals ratios 2015 accounts payable times income 2015 revenue. Other short-term liabilities equals 2015 other short-term times income 2015 revenue. And finally, other long-term liabilities equals ratios 2015 other long-term liabilities times income 2015 revenue. So very quickly, we have created dollar forecasts for 2015 for those 9 ratios by multiplying the ratios by the 2015 revenue and dollar forecast, and that's gotten us those 9 balance sheet items. Right? Balance sheet item number 10 is going to be operating cash. Here we turn to the assumptions tab. As I mentioned, assumptions tab are going to be some miscellaneous assumptions that we make. The primary difference between the assumptions tab and the ratios tab is the ratios tab are kind of year by year, period by period assumptions, where the assumptions tab are assumptions that don't change as the years change. So kind of universal assumptions, right? So one universal assumption we're going to make is how much operating cash a company requires, right? And that really shouldn't change year by year. And we're doing it as a percentage of revenue. Now, as a placeholder, I have in there 2%, which is 1/50th of the year, which is about 1 week of cash, right? We could obviously change it by company, and the book talks about how we can estimate operating cash. But in this case, what I'm going to do is I'm going to go back to my balance sheet, and I'm going to say equals, from the assumptions tab, operating cash as a percentage of revenue, so assumptions B3, times, from the income tab, 2015 revenue. 1,094.3. Now, in just a minute, I'm going to copy this forward. And the problem is going to be, because there's only one cell B3 that I'm referring to, when I copy it into future years, it's going to cause me a problem, because it's going to change it to C3, D3, E3, F3, etc. So what I want to do is I want to make this what's called an absolute reference. To do that in Excel, I put a $sign in front of the B, what used to be called a string, and a $sign in front of the 3, which means no matter where I copy and paste this, it will always refer to assumptions B3, okay, which is operating cash as a percentage of revenue. 1,094.3. Now the key to finishing up the balance sheet, and by the way, we're about 5 minutes from being done, the key to finishing up the balance sheet is to make sure that we finish it up so that we get a balancing balance sheet without a circular reference. We cannot have a circular reference in our model. That's an invalid model. So I'm going to show you how to get a balancing balance sheet without a circular reference. So in order to do that, we're going to finish up the liabilities and equity side of the balance sheet first. So start with equity. Total preferred equity for 2015 equals the previous year. Again, since we're not changing the capital structure, whatever equity they had, they're going to keep. Minority interest, same concept, equals the previous year. We're not going to forecast change in minority interest. Share capital equals the previous year. We're not going to buy back or issue any new stock. We're going to leave the equity alone. The only thing that will change is retained earnings. So retained earnings for 2015 equals our starting retained earnings, so equals G30, plus from the income tab, in 2015, we forecasted a change in retained earnings, H27. So it's our last year's retained earnings plus the 2015 change in retained earnings is going to be the ending retained earnings at the end of 2015. When I sum those four items up, that gets me my total equity forecast of 18,866.7. All right, finishing up the balance sheet. Short-term borrowings. Since we're leaving the cap structure alone, short-term borrowings equal the previous year. Not going to change the debt. That gets me total current liabilities, which is the sum of the three above. Long-term debt, long-term borrowings equals the previous year. Pension liabilities equals the previous year. The assumption with pensions, under U.S. accounting law, companies are not allowed to have unfunded pensions going forward. Therefore, we're going to assume all new pension obligations are NPV 0. So the only pensions we're going to worry about are the existing unfunded pension liabilities. So equals the previous year, 8963. Total long-term liabilities are the sum of the three items above. Long-term borrowings, long-term liabilities, pension liabilities. Total liabilities equals total current liabilities plus total long-term liabilities, 67,688.7. Total liabilities and equity equals total liabilities plus total equity, 86,555.4. So very quickly, we have finished up the liabilities and equity side of the balance sheet. Now again, it's very important to get our balance sheet to balance. So here's how we're going to do it. We're going to take total assets in 2015, H15, set that equal to H32. That's how we get our balance sheet to balance. We're forcing it to balance. Assets equal liabilities and equity, so it balances. Now, for those of you thinking ahead, in order to get all the assets to add up to that amount, we're going to need what's called a plug. We're going to have to solve for something in order to make the balance sheet balance. Our plug is excess cash. Okay, so the plug is going to be excess cash, which means we need to have every other balance sheet item solved for with the exception of excess cash. The one balance sheet item we don't have solved for is goodwill. Again, too hard to forecast acquisitions, so we're not. Okay, because we don't know what the price is going to be. We don't know who they're going to buy. We don't know how much they're going to buy them for. So therefore, it's too hard to forecast acquisitions. And goodwill is no longer amortized, just sits there. So therefore, goodwill equals the previous year. Now we're ready to create our plug for excess cash. Here's how you do it. Excess cash equals total assets minus everything else. So H15 minus operating cash, H4, minus accounts receivable, H6, minus inventories, minus other current assets, minus long-term investments, minus net fixed assets, minus goodwill, minus other long-term assets. if I did it right and I hit enter, not only will I get 8694.1, but more importantly, Excel will not give me a circular reference. So if I do this and it says circular reference, then I made a mistake. But now what we've done is we've actually created a balance sheet forecast that does not have a circular reference and solve for excess cash. So now I can fill these other items in: total current asset, sum the items above, total long-term assets, sum from long-term investments to other long-term assets. Those 4 items, and that would get me my long-term assets and a balancing balance sheet. Once I have my balancing balance sheet, I take 2015, I copy my entire balance sheet to column M. So I now have a forecasted balance sheet. Copy it right. Going out 6 years. That, very importantly, balances. Final step, go to my TFI, take my 2014 TFI, which is a relative reference to all of that, copy, paste to column M, change my years to relative references. I now have a forecasted TFI going out to 2020 that balances. Now that I have a balancing TFI from my balance sheet and a balancing TII from my income statement, I can then go to the CFI tab. I can take the 2014 CFI, copy that out to column M, and I now have a forecast for CFI that balances 1989.4 going out 6 years. That's the number that I'm looking for, which was really the whole point of why we did this. Economic profit tab, same process. Take the 2014 economic profit, BOI, copy and paste that out 6 years. This one requires relative references for the years. I got balancing beginning of year economic profit, end of year economic profit. Take 2014, copy it, paste it out 6 years. I now have balancing the end of year economic profit going through 2020. So in about 45 minutes, what we've done is we've created a model that, based on the ratios and a few assumptions, forecasts out 6 years worth of income statements and balance sheets, which gets us 6 years worth of economic statements, which gets us 6 years worth of cash flows. Now, all that is predicated on those ratios coming true. Now, these are placeholder ratios, and where we will go in future classes is we'll then start making changes to the ratios, which will change the assumptions, which will change the income statement and balance sheet tabs, which will change the cash flows, and ultimately will change the valuation. All right? But as far as part 1 of your homework assignment for homework 6, if you've gotten to this point, you've completed homework 6. So at this point, you just save the file, upload it to Elms, you're done with homework 6. If you didn't get to this point, then you need to get to this point by 10 a.m. on Wednesday, because it will be at this point that we will pick up on Wednesday and we will complete the valuation of Caterpillar, doing a DCF and an economic profit valuation. And then next week, we'll do multiples. And then by the end of next week, we're done with all the new content that you're going to get for the semester. And then between the end of next week and the rest of the semester, it's just application. Okay? Just changing companies and the art of valuation, trying to value different companies. And as I said, this is the model, when we finish it by next week, that you're individually building, that one of your team members will use. They'll pick your model, and then that will be your group project model that you'll use as well. But I wanted everybody to individually build it first. So as I said, this is homework 6. We'll pick up here on Wednesday, and then we'll create homework 7. All right? But before you go running out, a couple more things. Number one, you'll notice that in the CFI, that the CFI is not changing for the last 6 years. Anybody know why? Anybody know why the CFI is not changing in the last 6 years? Stays at 1984 or 1989.4 for 6 consecutive years. This would have been a good part B of the midterm question if we had gotten to this point. Essay question. But why is the CFI not changing? We have a good answer to that one? What did we say about capital structure? We're not changing the capital structure. So what did we do with all the payouts? Did we issue stock? Pay back stock? Did we change the dividends? Did we change the interest? We didn't change the capital structure. We didn't change any of the payouts. So therefore, CFI stays identical because we're not paying anything out. So what's happening to all the profits that CAT makes if we're not paying it out? What happens to all the free cash flows? Where do they show up in our model? And I'll give you a hint. It shows up in the balance sheet, and it's the growth of excess cash. So the excess cash eventually grows to $20 billion. So that's the point. From a valuation standpoint, what we're forecasting is the excess cash that can be distributed. From a valuation standpoint, what we're not forecasting is how the company is distributing it. What we know is that CAT will eventually have $20 billion that they can choose to distribute in any way that they see fit. And that will drive the enterprise value of CAT, not figuring out what the dividend and figuring out what the stock purchase is. So there's actually a beauty to this method because it actually, on the one hand, is complicated, but the other hand, it simplifies it because what it really says is this is the amount of cash that CAT has to distribute. And then it's a second question for how they want to choose to distribute. And what we're not going to get caught up in our model is trying to figure out those distributions because that just adds a lot of complexity, which doesn't change the value of the company whatsoever. So that's the why this model is the way that we're doing it. And so excess cash is the proxy for what can be paid out, okay? Which actually goes back to the theory of what excess cash really is. So that's one nuance about this model. The other nuance that I wanted to mention to you is there's a tab in here called change in equity, which you don't have to copy out until 2020, right? And basically, the change in equity tab I created for this model because accountants, and this is what I told you before the midterm, accountants make adjustments to equity directly on the balance sheet. And unfortunately, we would have to solve what those adjustments are to get balancing CFIs. So I created this change in equity tab to basically solve for the other adjustments to equity that the accountants made to CAT's balance sheet so that I could get our CFI to balance. That's why I did not give you as an assignment the actual map accompany CFI to Bloomberg's actual statements because you would have never finished that assignment because this is really hard, right? So that's what this other adjustments to equity tab, change in equity tab is all about, is it's about figuring out the accounting adjustments that accountants make. Now here's the beauty, is in our model, we're not forecasting any adjustments. We're not forecasting any accounting changes. So in the future years, you can move this tab out, but it doesn't really matter because we're forecasting clean balance sheets. But unfortunately, the accountants, and CAT's another example, give us unclean balance sheets. So I had to go back and solve for some of those adjustments they made. Otherwise, you wouldn't get balancing CFIs from year to year to year. So that would have been really hard. I didn't give that to you on the midterm. It's unfortunately something you have to deal with real life. That's why I gave you the model as opposed to made you create that extra step from the model because you would have really, really struggled with figuring out these other adjustments and figuring out how to get the CFI to balance. Unfortunately, I can't tell you that I caught every conceivable adjustment that accountants can make. So as a word of warning, when you get to your groups, you might actually have unbalanced CFIs for reasons that I did not catch. And it will be your group's responsibility to balance the CFIs on your group project. Last semester, out of 27 teams, it happened to 2 poor teams. And they really struggled figuring out how to balance their historical CFIs. Now, the way we've set up the model, the future CFIs will always balance. So it was only the historical CFIs, and it had to do with weird stuff that the accountants do. Hopefully, that won't affect any of you, but nonetheless, if it does, that's when this other tab comes into play, because it helps you try to figure out what those adjustments could be, and then you have to figure out where on the balance sheet they were, and any balance sheet items that we might have missed in the model tab, and then add them back to the model. I think I've caught everything, but again, accountants keep doing crazy stuff. So when they do crazy stuff, we got to figure out how to handle the crazy stuff that they do. So again, that's just some additional words I wanted to make about the change in equity tab and why we really don't otherwise have to carry that out 6 more years. So again, on Wednesday, we'll pick up at this point, and from there, we'll finish up part 2 of the model. So if you finished, upload it, you're done with homework.